You would see all markets collapse. You'd see a derivatives daisy chain of collapse. I mean, all roads do lead to gold and silver ultimately, and that would be the road right there. If you don't have gold, if you don't have silver, you don't have wealth. But that reality will occur. You will get a much, much lower silver-gold ratio once one of the two fails to deliver off of either COMEX or LBMA. I mean, we'll at least come down to 25 or 30 to 1 ratio from the current 90. So your silver is going to outperform gold 3 to 1 if, when that happens. But under current pricing, 10,000 ounces of silver, you can't retire on that.
A foreign exit from US Treasuries would trigger a cascading collapse across global markets, starting with derivatives and credit. In this breakdown, only gold and silver would preserve real wealth. The Fed would be the sole buyer, but would be overwhelmed almost instantly, making default the only outcome. Global investors have started questioning the American exceptionalism narrative amid market turbulence caused by U.S. trade policies, which can profoundly impact asset allocation worldwide, according to a managing partner at a leading Swiss wealth and asset management firm, the Pictet Group. Historically, 1,000 ounces of gold or 10,000 ounces of silver meant lifelong wealth, but paper suppression has destroyed that benchmark. Financial expert Bill Holter states that with COMEX or LBMA failures looming, the gold-to-silver ratio will collapse, setting silver up to outperform gold. Once that happens, silver's true value will be restored, and 10,000 ounces will once again mean real wealth. Silver's smaller market size and industrial applications make it more sensitive to economic trends, particularly in the tech, solar energy, and electrification sectors. In fact, during the 2020 pandemic recovery, silver surged 47.9% compared to gold's 25.1% rise. Since there hasn't been a full audit of U.S. gold reserves since 1956, Bill Holter questions whether the gold is even there. He says a COMEX or LBMA delivery failure would expose this shortage, likely prompting China to abandon the dollar. Ultimately, he believes the West's attempt to revalue gold will fail, and market forces will reset gold to its true value. If tariffs make COMEX gold more expensive, some demand may shift to other markets, such as gold ETFs or the London over-the-counter market. A sudden spike in demand could raise gold prices and push up leasing rates, which could in turn make physical gold products more expensive. Any such shift in demand patterns remains to be seen and would not be without its challenges. Before we dive into Bill Holter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
You would see all markets collapse. You'd see a derivatives daisy chain of collapse. I mean, all roads do lead to gold and silver ultimately, and that would be the road right there. If you don't have gold, if you don't have silver, you don't have wealth, because you'd see a complete seizing up of credit markets all around the world, and everything runs on credit, whether it be the financial system or the real economy. I mean, goods will not make it to market without credit. So, I mean, that scenario is the scariest scenario of all. If foreigners just completely backed away, then that would lead to other foreigners saying, hey, wait a minute, there's no buyers, I want to get rid of mine. And you'd have trillions of dollars of treasuries being dumped, and who would be the buyer? The only entity could be the Federal Reserve. They would be overwhelmed overnight. I would say after you get a reset, 10,000 ounces of silver should do it. In today's pricing, no, obviously, $400,000 is not, you're going to burn through that even if you just did 20,000 a year, which that's obviously not enough to live on, but 20,000 a year, it's going to be gone in 20 years. Now, just from a historical perspective, Dunnigan, you could go back a couple hundred years ago and all the time before 200 years ago. If you had 1,000 ounces of gold or 10,000 ounces of silver, you were considered a very wealthy person. And that was all you needed for the rest of your life. Now, because of the suppression the paper derivative suppression of both gold and silver pricing no longer holds. Obviously, if you've got 1,000 ounces of gold, you've got $3.5 million. That's probably enough to retire on. I mean, 1,000 ounces, if you've got 1,000 ounces of gold, that's enough to retire on. But if you got 10,000 ounces of silver, which, 100 years ago, 500 years ago, 1,000 years ago, 10,000 ounces of silver, it was a ratio of 16 to 1. So if we had a ratio today of 16 to 1, where would that bring silver? It'd give you a number of what?
It depends where gold is at that time. But yeah, in terms of ounces.
Well, no, but I'm saying if gold doesn't change, if gold didn't change and you had a ratio of 16 to 1, but that reality will occur, you will get a much, much lower silver gold ratio once one of the two fails to deliver off of either COMEX or LBMA. I mean, we'll at least come down to 25 or 30 to 1 ratio from the current 90. So your silver is going to outperform gold 3 to 1 if, when that happens. But under current pricing, 10,000 ounces of silver, you can't retire on that. Okay, well, that's assuming that we do have the gold. There's not been an audit since 1956. I personally assume that we do not have the gold, because if we did, why wouldn't we show an audit every year or an audit every 5 years or 10 years or whatever? There's not been an audit in 70 years. The U.S. can't just go out and just gobble up gold because there's not that type of size available. And to answer his question, yes, I still believe that. And a failure to deliver by COMEX or by LBMA will certainly be a marker that the Chinese will look at and say, hey, wait a minute, there's no more gold to be had. Let's pull the plug. I think the West is probably going to revalue first, and it's not going to work. The first reset is not going to work. You may see the East or / Mother Nature mark gold and marked assets fair, logical, water seeks its own level to values that.
This year, both US Treasuries and the US dollar have uncharacteristically failed to provide their traditional safe haven protection during periods of equity market volatility. Looking back to 2022, the market was already signaling its unease when the conventional inverse relationship between real US Treasury yields and the price of gold broke down. Investors appear increasingly willing to accept the opportunity cost of holding gold, even as real yields rise, suggesting a shift in market preferences and a reassessment of risks. The U.S. Treasury market is the backbone of the global financial system. However, if foreign buyers stop attending auctions, the entire system is in jeopardy. Holter warns this would collapse bond prices and expose a terrifying truth of the Fed losing control over the very market it claims to manage. Federal Reserve Chair Jerome Powell on Friday gave a tepid indication of possible interest rate cuts ahead, noting a high level of uncertainty that is making the job difficult for monetary policymakers. The U.S. debt is now mathematically unfixable. The only way out is a default, either through non-payment or by destroying the dollar's value by 80%. Holter warns that while BRICS nations are building a gold-backed parallel system, the coming U.S. Treasury collapse will still cause global pain. When the financial reset hits, metals will soar while paper assets collapse, but Holter warns that a world of $100,000 worth of gold is a world of severe economic turmoil. Holding metals makes you a survivor, not a winner. Let's get back to the interview.
Well, first understand that U.S. Treasuries are the foundation for the world's financial system. So that's first and foremost. If we had an auction where there were no foreign buyers, that would create massive selling, because who wants to be the last one out the door? And if treasuries are being sold and there's no buyers, then the bond prices drop and interest rates go higher. So can you imagine that happening at the same time the Fed's cutting interest rates? The Fed cuts rates, but yet there's no buyers for the debt. I mean, you'd have market rates going higher with the Federal Reserve losing control of yields, losing control of the Treasury market. I think they've purposely been trying to suppress the prices. I mean, the prices get suppressed with derivatives, who's doing the suppressing? It's done with paper. It's done with paper contracts. I mean, yeah, obviously the best thing to have done was not go off the gold standard, get our fiscal house in order and bite the bullet back then. It was only a small bullet. Now it's a cannonball the size of the moon. It's not doable now. You cannot fix it. It's mathematically done. The debt cannot be repaid. So the only option is to default, when I say default, the only option is to either not pay or destroy the value of the dollar and make it possible to pay the interest and to pay the principal back. And you'd have to have a dollar that dropped, 80% or more for that math to work out where the debt would be payable. In a perfect BRICS world, you'd still see massive problems all over the world because the dollar is so prevalent. And the dollar is just an offshoot of treasuries. That's what treasuries are denominated in. So as far as foreigners are concerned, if they've unloaded gold, they're going to do relatively much better, but there's still going to be all kinds of pain. Now, the Western world, you're going to see a complete wipeout with countries that have no gold, and you're still going to see big damage on countries that do have gold because no one has as much gold as they have treasuries. I mean, treasuries are the lion's share of the balance sheet for both foreign central banks and for foreign sovereign treasuries. Foreign sovereign, treasury. I'm not saying US treasuries, but foreign treasuries themselves hold US treasuries. And when the US treasuries melt down or evaporate, that's going to leave giant black holes of nothing. I would say, because nobody knows, when the plug is going to be pulled. I mean, my advice would be don't liquidate so that you have a year's worth of bills. You might want to liquidate so that you have only 2 months worth of bills, and then 2 months from now, liquidate again. Because the longer this goes, the higher the price of silver and the more the likelihood that we have the reset where all of a sudden, wow, you've got a lot of capital, and that's going to happen at the same time that you see paper assets, bonds and stocks drop in value. So your relative position, the more metal you hold, or if you can hold it long enough, you'll have capital. I'm not going to say you're going to be the winner because that's not the type of world. I've always said, be careful what you wish for. $100,000 gold sounds good to somebody with gold, but what kind of world will we be living in?
The Financial Times revelation has sparked considerable debate about where gold prices might head next and what this means for the market. While the situation could lead to volatility, it's important to remain rational and focus on the facts. The U.S. government could change its position at any time, which might ease or increase market pressures. According to Morgan Stanley, industrial demand accounts for approximately 50% of silver consumption, creating a fundamental demand floor that doesn't exist for gold. Smart investors know that gold and silver complement each other, creating a more robust precious metals strategy than either metal alone. Think of it as building a team where each player has unique strengths. If the U.S. Treasury market truly unravels and gold and silver reclaim their historic role as real wealth, will you be prepared to survive the reset? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.